Always being very, very, very kind. And it was interesting, Jack, because I was listening and I was reading through some of the sort of the comments and some of the sort of the quotations were there, and there were some fantastic quotations in there, right? There's a wealth of experience and wealth of knowledge. Guys, everyone, thank you very much for inviting myself. I'm just watching my time in terms of the time that we have. So Jack suggested that perhaps I sort of spend about half an hour or so, roughly at a high level, to go through with some of the basics from a tax side of it. Along the way, absolutely interrupt me with any question that you have, but at the end perhaps we can sort of take a whole bunch of sort of question. I want to touch base a little bit on the negative gearing, and not so much it was part of the presentation as such, and it was interesting how you sort of put a perspective on a business side of it, and I agree with that perspective of the business. I look into a little bit more on a historical side of it, right? So we look back in the early 80s, and we did try to take away the negative gearing, right? So the old time with the Bob Hawke and sort of as being the Prime Minister at that stage, and Paul Keating was the Treasurer. So they tried to take away the negative gearing at that stage because Australia was expensive, we're giving away too much on the tax benefit and so forth. What was the end result? The result was that in mid-80s, negative gearing was taken away. And once the negative gearing was taken away, what it was being found is that because the incentive or the apparent incentive is not there, there is no new development. So there is no new construction. So all of a sudden what it was being found is that the supply of the properties sort of dried out quite a bit. So over the couple of years, the supply completely dried out, and the rental demand is something which is progressive, right? The population grows, so you're supposed to have the rental demand. So what the government sort of found is that while the supply has sort of stopped and the rental demand keeps sort of increasing, all of a sudden the rent was very, very expensive. And then what the government sort of found is that over a period of time that there are fundamental attributes, fundamental changes, fundamental effects on our day in, day out because of this. So what that meant is that people could not afford the rent. People struggled to afford the rent. So all of a sudden, because the demand was there, it was more of an auction with the rent. So you start with $300, someone proposes $310, you go $320, and then we found other attributes is that people used to share the sort of the accommodation rather than having the old Aussie, 4-bedroom house, double lock-up garage and the big backyard. You sort of start to sort of share the rooms. So government sort of found that, hang on, that's not what we wanted. What we wanted by taking away the negative gearing is to provide an opportunities for the next generation to be able to own their own home. And the impact is quite contra. So the government sort of went back and government said, well, perhaps we made a little bit of mess out of it, yeah? So government has taken away the negative gearing. Now, the subsequent ramification when the government has taken away the negative gearing, because it did not have any negative gearing, so for about a couple of years there were no, I suppose, tax benefits were provided by ATO because negative gearing was not applicable. But the losses that you used to make on the negative gearing, you never lost the losses. The losses is to be accumulated and carried forward. So when the government reinstated the negative gearing, all of a sudden people could use the losses for, say, 3 years into one hit. So from ATO's point of view, all of a sudden 1 year, ATO fundamentally had no revenue. And ATO says, guys, you really made a big meal out of it, didn't it? So that was the impact, right? So it comes back to the old philosophy, the invisible hand of the economics, right? You let the economics to run on its own way. And if Australia is one of the more expensive on the OECD countries, it will find its own fit. The supply and the demand, you don't want to play with it too much. So that's why I hear quite a bit with the negative gearing. I hear quite a bit with the negative gearing, but at the same time I sort of say that, you know what, we tried it once and good luck, let's try it again. Because the end result, believe it or not, is that while the rent sort of increased over a period of time, the end result is that when the negative gearing was reinstated, the rent really hasn't dropped quite a bit. It got slightly modified, but really hasn't dropped quite a bit. So then the investors who are out of the market, they sort of say, hang on, the return seems to be pretty good. So we should go back to the investment, right? Because the negative gearing is being reinstated. And then all of a sudden you've got the demand in terms of the purchase and the construction, the prices have started to increase. So the end result was, from an investor's point of view, the people who stayed within that transition, not only they had a higher level of rental return, they also had a good price growth as well. So who sort of lost within that exercise? The people who were targeted to be helped in the first place. Yeah. So that's a bit of a history, I suppose, with the negative gearing side of it. So Jack sort of asked me to go through with all the slides. So, okay. All right, so it's all about tax planning, and you're right. I mean, tax could be a little bit dry, right? So just looking through this entire group and sort of new chairs being coming in at the end, it's exciting, yeah? All right, so what we'll do is that we'll discuss a whole bunch of things on tax, yeah? So we might start with some of the basic things as a start. So we'll get some of the basics out of the way. The whole presentation is more about the property investments, yeah? In terms of the property investment side of it, what can we claim? What are the things that we should be claim, and what are the things perhaps are not allowed to claim? Where are the strategies in the longer period of time? What's the asset protection? What's the tax planning? What's the succession planning? So what's the estate planning? So all of those things we'll look through, yeah? So we'll start with the general deduction, very simple. Then we'll go through some of the uncommon deductions, some of the deductions that I've seen over the years, that things perhaps you sort of miss it at times. And you miss it if you're not an expert on that field, yeah? So we'll spend a bit of time in terms of the structure. Structure is a common question that I hear all the time. Jack, do I buy on individual name? Do I buy on company? Do I buy on trust? Do I buy on superannuation fund? You know, what's the flavor, right? Where do we buy? We may discuss a bit in terms of the ETIO attentions. And when I refer to ETIO attentions, it's more in terms of what are the areas that ETIO sort of target every year, and what are the areas that ETIO sort of say, well, you know what, these are the things that we are sort of considering. So we'll discuss this. Based on the time, we'll discuss a little bit on the some of the case studies and the strategies, if I may, yeah? And the case studies and the strategies, and one can go through many examples, we'll see how we go with the time. And we may take some of the questions at the end as well. So as a property investor, and I'm being fortunate, I'm been investing about 19 years now, and I look back into 19, 20 years. I look back into 1999 when I bought my very first property, right? I bought my first property because my father asked me to buy it, second and third and fourth, and so I bought it randomly. So once I had about 5 or so property, that was the first time that I sort of sat down and I said, you know, why am I doing it? And what's the longer term goal in terms of all of those things? Let's learn a little bit more in terms of all the strategies. So I started with some of the basic things, yeah? So when you do your tax return with your accountant, is in your tax you would see that you've got a rental schedule, right? And the rental schedule has got a whole bunch of basic deductions. So most of those deductions are pretty obvious, yeah? So you buy a property, you borrowed a bit of money, so your interest is tax deductible. You buy a property, you've got your council rate, you've got your water rates, they're tax deductible. You buy a property which is a unit, townhouse and villas, and you've got some body corporate rate, you've got some community fees, those are all tax deductible. You pay insurance, whether it's a landlord insurance, whether it's your content insurance, whether it's your building insurance, which is the most common. So all of those insurances are deductible, yeah? You do some repairs and maintenance. The brand new properties, whether we have lots of repairs, over a period of time you do some repairs and maintenance. All of those repairs and maintenance, they are tax deductible, yeah? You do some cleaning, some pest control, and others. So others, what it basically means, and I'll come back to depreciation in a second, but others, what that basically means is that any deduction that you have where it is quite clearly the deduction is in relation to that particular investment property. The term that they use is called nexus. When you have an absolute nexus in terms of your deduction with the investment property, those deductions are deductible, subject to some clauses and so, which we'll go through in a second, yeah? Depreciation is the most common one. So Jack, all sort of your investors, I suppose, is quite a bit in the property investment. So depreciation is very common. And
call it the free money.
Call it the free money. And that's a very good way of saying it. And why is it free money, right? Depreciation is not an additional deduction. You've already bought it, right? So say as an example is that Jack sort of bought this property. Let's just say this is a commercial property that Jack is buying, and let's just assume that it's a brand new commercial property, right? So Jack paid a certain amount of funding. We'll just make it 500,000 for argument's sake, yeah? This property has lots of attributes attached to it, assuming it's a new property, yeah? So you've got the carpet, which is the brand new. You've got your tiles, and you've got your sort of the hot water system, and you've got your blinds and so forth. All of those are part of your purchase or part of your construction. You haven't paid it for the second time. But what ETIO does with the free money is that ETIO sort of allows you to say, well, all of those you can deduct. Mind you, there is a bit of adjustment which went through in the last budget, which is the budget, the adjustment ETIO suggested is that if it's a brand new property, as you guys are purchasing, there is no impact. But if someone were to buy a second-hand property as an example, and second-hand in the sense that it's not a brand new construction as such, then you can't claim the incidentals, which are the plants and equipments. You can't claim the carpets and tiles and so forth, simply because it's not a brand new anymore. Brand new property you still can, the second-hand property you can't. You still can claim a concept called structural deduction, right? So the actual skeleton, so the walls, you know, the skeletons that we sort of prepared as such. So that's the free money. And depreciation is something that I hear question all the time. Munzurul, is it worthwhile to depreciate? Is it worthwhile to do the depreciation? There is a bit of cost depending on who you go, $500-700 cost. Is it worthwhile? The answer, which I sort of always sort of say, is that have a chat to a good quantity surveyor, because the good quantity surveyor very often can provide you an estimate. An estimate saying, well, that's your cost, that's what we sort of expect the value of the deduction would be in the first year. What I can say from my personal experience that the benefit is quite significant, right? Quite significant. And once you pay that sort of a one-off fee, you can use that depreciation report for the useful life of the property, which is over a period of time. Yeah, so it's very, very, very worthwhile. So all of those things are deductions. So you as an investor, I suppose your comment would be is that when you do your return, make sure that all of those are being claimed. Basic things, yeah? So you are an investor, you've got the council and the water rates. How many we are expecting? About 4.
So is the difference review, is this made every year or is this made only once?
Good question. Good question. The question was that the depreciation report, does it need to be done every year or is it done only once? The beauty of it is that you actually do it only once. An accountant can't do it. So we as a profession, we are not allowed to do it. It needs to be done by a registered quantity surveyor. What the registered quantity surveyor does is to provide you the depreciation and provide you the deduction on a year-by-year basis. So it's a one-off cost, which is tax deductible, and you get the report for the entire sort of a life. Yeah.
For the first 7 or 10 years, or is it beyond that? 40 years.
It's over the useful life, so it's not 7 or 10 years, it is up to 40 years, yeah? And where that 40 years comes in is that you can claim up to 2.5% as a building depreciation. So because it's a 2.5%, which is the building depreciation, it's over 40 years you can claim. So I suppose as an investor, your comment would be is that when you do your return, make sure that all of those things are included. Has your accountant included 4 lot of council rates? Has your accountant included 4 lot of body corporate rates? Has your accountant included the insurance? If there is a prepayment, has your accountant included the entire insurance? Are the interest being claimed by your accountant? Where it is more important, I suppose, is that those are basic, yeah? So interest we know where we can claim. Where it becomes a little bit tricky. An example could be, let's say, mom and dad investor who's sort of purchasing one brand new property. Let's make it 500,000 again for argument's sake, the brand new, and let's just assume the overall, including the incidental cost, the council, the stamp duties and the solicitor's cost, is about 525. As a rule of thumb, I sort of say that about 5% in addition to the purchase price, right? So if you buy it at 500,000, 525 is the overall cost. So you go to GR Prosperity, and GR Prosperity sort of organizes everything for yourself. You get a loan of 80%. Yeah, because the bank is sort of saying that, look, the Royal Commission and a couple of other things, we're a little bit conservative at the moment, we'll give you 80%. So you get a $400,000 loan. So you go to your accountant, you say that, well, there is a designated $400,000 loan. Of course it is, the $400,000 is deductible. The question comes in, and this is where I suppose the experience is that where is the rest of the fund coming from? Yeah, remembering that on that example that your purchase price was 500 and with the incidental cost it was about 525. Yes, the bank loan was 400. So we as an accountant, what we do is that we always ask you the question, how did you receive the other? You borrowed about 20% deposit, 5% incidental, you borrowed 80% on the next brand new property, you bought your first investment property. Brilliant. Now you go ahead and buy your second investment property, right? It can become even a little bit more tricky. Tricky in the sense that the first property, say for argument's sake, was bought on the gentleman's name, and the second property maybe, say, bought on the wife's name. Where do you claim? That's sort of the additional, because he may have used the first property now as a deposit to buy your second property, yeah? So those are the things that you need to explore with your accountant. And always remember, a fundamental thing with the tax side of it, irrespective as it sounds, is that it still needs to make some logic at the end, right? So what's the underlying purpose? How did we got that money? What was the uses of that money? As long as we can show that the uses were purely for investment, we can claim it. So interest on deposit is a common one that I see very often people miss, yeah? The borrowing cost is another one that we sort of see very often people miss. So what's a borrowing cost? Is if you borrow up until 80%, arguably there is no LMI. But if you borrow more than 80%, you pay that LMI. What's an LMI? LMI is lender's mortgage insurance. So it's like an extra cost that the bank charges you, because the bank says, well, you guys are a little bit more risky at the moment. You're borrowing 90% as opposed to 80%. So we'll charge you an extra fee. Now, very often we don't see it. And we don't see it because very often the LMI, lender's mortgage insurance, is being capitalized. So you don't sort of pay it out of your pocket. Because you don't pay it out of your pocket, you sort of know it, you don't know it. Yeah? So you need to watch out. And very often you would see is that when you borrow, say, 90% on a particular loan, that it's a 90% including the LMI. So your actual borrowing probably was about 87.5%. Your 2.5% is the borrowing cost. So you need to make sure, if I may, is that at a bare minimum you explore that with your accountant. Have you claimed my lender's mortgage insurance, which is deductible over 5 years? So it's not only the lender's mortgage insurance, right? So there is a whole lot of other costs. You may do some level of building report, you may do pest report, you may do pest control, you may do a strata report. So all of those costs which are associated to lending are deductible over 5 years. So make sure that we do include. Settlement adjustment is the one that I see very often that sometimes sort of people sort of miss as well, right? Particularly if it's a brand new property being purchased from one person to a different person. When you go through the settlement with the solicitor, at the end of the settlement, solicitor will have a whole bunch of additional costs which are all being adjusted as part of the sort of the purchase. Things such as your section 109, things such as your bits and pieces of sort of the reviews that the solicitor has to do. So make sure that all of those costs, you raise it to your accountant and all of those costs are being claimed, yeah? Common thing I hear from people is interest in advance. People say, wow, that's a fantastic tax planning strategy, right? So I pay 2 years interest in one go, and I can claim this year's interest as well as next year. So what ATO allows you, let's just say you've got a $400,000 mortgage, and let's just assume that your interest rate is about 5%, so you pay about 20 grand, yeah? So what ATO says is that if your bank allows you, you're welcome to pay this year's interest as it is, but also next year's interest in advance. Now sometimes that could be a very, very, very effective tax strategy. Example, let's say husband and wife, and the wife is sort of going into maternity leave next year as an example. So those additional deductions are not that relevant to the wife to the next year because there's not a whole lot of income. So I would much rather go through with the interest in advance and claim it. But in many cases it may not be, yeah? So you run that through. Similarly, the prepayment, there is a whole bunch of additional cost that ATO allows you to claim it in upfront. Things such as, say, insurance as an example. So very often we pay that on a monthly basis, and very often the interest of the next 12 months you pay it in one hit. So make sure that your accountant claims all the prepayment of the interest. Land tax is a bit dreaded, isn't it? And you know, land tax is one of those extra tax, and it's complicated. Complicated in the sense that each state is a bit different. Like in New South Wales as an example, let's say depending on whether you buy it on individual name, whether you buy it on trust. On individual name you've got a threshold, 600,000. On a trust as an example there is no threshold, so you pay land tax from $1 on trust. If you buy it in Queensland as an example, that there is a threshold in trust up to 350,000. Individual you've got a little bit higher, but you've got a threshold. So each state is a little bit different. Where you buy is also a bit different, which entity you use. But I suppose the comment is to make sure that your land tax, you raise it to your accountant, it gets claimed. Land tax is one of those rare of the tax where the tax can be claimed as a deduction, yeah? And you've got to be a bit careful, like in New South Wales, as an example, that land tax in New South Wales, you need to register. That's your responsibility as a landowner. In Queensland, as an example, the Office of Estate Revenue registers it.
So the land tax, is that synonymous to stamp duty?
It is indeed. It is indeed. It's quite sort of, I suppose, independent to stamp duty, right? So stamp duty is something which you pay when you purchase a property, and land tax is a sort of an additional tax, if I may, that you pay if your land value is higher than the threshold that the ATO sort of assumes that would be the threshold. Now, land tax is an ongoing, is a yearly tax. Now, the reason I raised the land tax is that land tax is something that we fell into trap at times. And how do we fell into trap is exactly the comment which I was saying, that each estate is different. Queensland, if you are purchasing property in Queensland, if you are obligated, you will get a land tax bill. Yes, you can dispute the valuation of this, but you would get a land tax. But in New South Wales, if you do not register yourself as an owner, then you're not going to get any land tax bill, because it's your responsibility as an owner, as a proprietor, to register. Then what it happens is that, let's say you own this particular property, and I had a client recently went through that we've been doing the accounts and the tax return of this client literally for last 9 years, 10 years or so, and the client just recently sold a land. And when the client sort of sold the land, client says, Munzurul, where is that land tax of 57 grand coming from? And I said, mate, where is the land coming from in the first place? Because I've never heard of the land. And the gentleman said, oh, I'd never raised the land simply because that there is no rent on the land. And he is right. Because what he did is that he received that as an inheritance from his parents, and because he received that as an inheritance and there was no rent as such, you don't need to include that. But where you get caught is that when you sell your property, is that right at that stage the solicitor does a concept called land tax clearance certificate. And this is where the solicitor sort of goes back as part of the check saying that, well, whether you are obligated to pay the land tax. And if you are, then the Office of Estate Revenue charges you land tax from day one all the way up until the time when you're sort of selling it, and they add away all the interest and penalty. So it can be quite a bit of surprise. So make sure that you don't fall into that surprise, Any question, any concern, give Office of Estate Revenue a call or complete the initial land tax registration. The comment which I haven't touched is the study expense, yeah? So the study expenses sort of covers a sort of an open bucket of any other expenses, anything which are associated with your investment property side of it, right? So I'm sure as an investor, you sit around at home late in the evening after the days of work or your business, and you pay the bills, right? You do the filing, and you send a couple of emails and so forth. So your laptop cost at that stage, your utility bills at that stage, your council rates, water rates, gas and electricity, and so a portion of it arguably is claimable, right? Again, from your perspective as sort of an investor, raise it to your accountant, right? When accountant should be asking you the question, but raise it to your accountant that, well, I've got 5 investment properties, can I claim some of those sort of things? Okay, so we'll look into the structure. So structure is something we can discuss, and I hear that question all the time. What name do I buy? Do I buy it on an individual name? Do I buy it on a partnership? Do I buy it on a joint venture? Do I buy it family trust, unit trust, company, super fund? I'm confused. And I say, well, you know what? There is no one answer, yeah? So the right answer would be, ideally, before you purchase any investment property, you run through with your accountant. Munzurul, my accountant, or other accountant, that this is what my circumstances are. Which name do I purchase? Yeah. So the answer to that question very often is that it's all about the relative benefits and the negatives of each structure, and how does that apply to your individual circumstances. That's what the answer is. So at a very quick nutshell, individual as an example, simple, right? Mum and dad, individual name, simple. So negative gearing, tax benefit, you can claim it on your individual name. Land tax wise, you get a bit more benefit because you get a lot more threshold. There's a benefit, individual. Negative of an individual is that you don't really have any asset protection. yeah? So you as an individual, you own it. Let's just say that you are a business owner and you run a import-export business. You've got a certain level of risk. Yes, you've got indemnity insurance, you've got other insurances and so forth, but you've got a certain level of risk as such. So if you own the asset, then your asset is being exposed for any level of future litigation as such. So you don't have that barrier, you don't have that corporate veil, so to speak, where it sort of protects. It's simple, but as it is in life, is that while it is simple, it doesn't have a lot of attributes. Partnership is arguably probably the most dreaded and perhaps probably the least sort of recommended structure. Right, very often mom and dad sort of comes in and says that, well, you know, mom and dad, 2 kids, we're purchasing a property together. And there is a practical reason. Why are we buying it? Because we bring in the kids' serviceability, we bring in the mom and dad's equity as an example. So there is an argument. Very often I see two family groups and 2 friends group coming in and saying, Munzurul, we're putting together our resources and we're buying it within both of us as family. It makes practical sense. Where it becomes quite tricky is that along the way, families sort of become independent over time, right? And when the families sort of grow, families sort of becomes independent. From a bank's perspective, it becomes quite a bit of constraint. Constraint in the sense that the way the bank sort of does is that, let's just say you've got family group A and you've got family group B. And family group A and family group B combine their resources to purchase a property of, say, $1 million. Right? The loan of the family group A is $500,000. Family group B, the loan is $500,000. Let's just say the rent is about $400,000, right? So our sort of a common sort of, I suppose, understanding sort of says that because the family group A owns half of the asset, that means the rent would be about $400 and the interest would be about $500, right? That sort of makes sense. But the way the bank sort of does is the bank takes your $400 as a rent, as half, but the bank takes entire $1 million mortgage against your name. And same as family group B, that the bank takes entire $1 million mortgage on family group B. And why does the bank does it? Do I like it? No. But why does the bank does it? Bank does it because this is from their asset protection, from their protection point of view, right? Because at the end of the day is that what the partnership is, it's a joint and severe liability. So what that means is that if one partner can't pay it, then it's the second partner is responsible for 100% of the obligation. And that's why I always sort of say that don't go with the partnership, even if in the earlier period of time it appears to be giving you more resources and more strength. In longer term it gives you a lot more constraint. Joint venture is that for a special project. So when you do a special project, you set up a special entity, you do a joint venture. More common, I suppose, is the family trust. So I've got few family trust on my own as an example. I've got few properties on my own as an example as well. Now, the benefit and the negative of family trust, I suppose the negative is that family trust comes in with a bit more complexity. So you got to set up a trust, you got to set up a non-trading trustee company. There is a bit of cost involved in establishing it. There's a bit of cost involved in running it. So it's a little bit negative. Land tax wise, New South Wales, there's no thresholds. Again, that's a little bit of negative, right? So there's a couple of negatives. The losses on a family trust, you can't utilize against your individual name. You don't lose the losses, but the losses you can't utilize. So there are a couple of negatives. Where the family trust becomes very, very effective, very, very effective is that under the family trust, you really do not own anything. You control everything on the family trust. And where the asset protection comes in is that if you don't own it, you cannot technically be litigated. Technically. You cannot technically be litigated. So you control it. So family trust is all about asset protection. Family trust also, discretionary trust, it gives you quite a bit of flexibility in terms of profit. So you might look into the short term and you might say, well, Munzurul, why would I go with the family trust? Because I'm earning about 100,000, I've got this brilliant depreciation, I want to claim it against my name and I want to receive all those tax benefits, which is true. But over a period of time, let's just say that particular property you bought it for 500,000 and you sold it for 1.5 over time, then that $1 million profit that you made over, let's say, 2 period, 1.5, 2 period, the $1 million profit that you sort of made, you need to pay the tax. And there is no tax planning. So one sort of look back and say that, you know, how much tax that he paid. Whereas within the family trust, what you do, you can distribute that profit to however you wish to. So it goes to kids and grandkids, parents, grandparents, brother, sister, nephew, niece, uncle, aunt. Very, very, very wide. So it's very tax effective, and it gives you lots of asset protection, comes in with a bit of cost, and comes in with a little bit of a short-term sort of a pain.
Family trust, for example, if the court, in litigation, deems you not a beneficiary of the trust, then you can still be successfully sued, and therefore your assets are not protected.
Very good question, very good question. The question was that, Munzurul, I'm challenging you, that is the family trust really 100% protected? Very good. The answer is, unfortunately, nothing is ever being guaranteed in life. Nothing is ever 100% protected, right? So when it goes to...
A vested trust gives you the ultimate protection.
Not a consent. Vested trust is fundamentally sort of no different than a discretionary trust, right? The trusts are two trusts. So you've got a discretionary, you've got a non-discretionary. People use different terms. So non-discretionary, as an example, I'm using the term unit trust. Discretionary, as an example, I'm using the family trust. People use a combination of it called a hybrid trust. People use a trust called a vested trust. So what the vested trust effectively is, people also use a term called vested trust. People also use a term called property trust. We make up the name, right? But fundamentally it's discretionary and non-discretionary. What's a vested trust does at a very high level, and we'll discuss later on if we need to, is that it extracts a certain level of asset or certain level of wealth from your existing properties and sort of captures it. It's like a piggy bank. So you create a bit of piggy bank where you do that. How do you do it? Whole lot of a strategy. You can create a second mortgage, you can create a charge, you can extract the equity, you can borrow money. So a whole lot of different ways. So you're right, very, very good point, that it does give you, because the control isn't there. The other, I suppose, that to go through with the old level of the challenge is that on the family law, as an example, the family trust has no impact. So when it goes to the family law court, if it does, the court sort of says, you know what, I'm going to take away the corporate veil, and whether it's being owned on the trust, whether it's owned on the individual name, I'm going to just purely look through the underlying beneficiary, who the underlying beneficiaries are, and that's how I'm going to distribute. So there are restrictions, but it is probably as good as it gets. Unit trust, on the other hand, perhaps arguably doesn't have a lot of discretion, right? So it's a unit, whoever the unit holders receives the benefit. But unit trust has its own place. And the place is, let's just say on that example where we suggested family group A and family group B, who are purchasing a property on a partnership. Depending on the value of the property, one may argue, rather than buying it on a partnership, why don't you consider on a unit trust? So by owning it on a unit trust, you can show to the bank very clearly that that's the designated units that I own, and that's the level of the funding, I suppose, you as a bank should be taking against my serviceability. One can make it more involved. One can have the units being owned by a discretionary trust. So there's many structure. Company is probably, again, probably not necessarily the best of the structure for an investment point of view. Company is all about business, right? Company utilizes for business. Our company is called Keshab Proprietary Limited. But Keshab Proprietary Limited doesn't own any asset, any property. Why? Because the company has a tax rate, which is a fixed rate. Used to be 30%, dropped it now to 27.5%. But in a trust, in a discretionary trust, whether it's a family trust or so, is that the profit can be distributed to an individual where there is a 50% CGT discount. So the maximum tax that you would pay would be half of that 46.5%, which is the highest marginal rate. That means the maximum tax that you would pay would be 23.25%. So what that means is that there are some significant tax benefit in terms of the discretionary trust where the company perhaps doesn't attract that. It gives you the asset protection, but that's sort of 27.5% and 23.25% over a bigger dollar value. It makes a world of difference. Super fund, again, it's a topic that one can discuss and one can discuss, right? It's quite a bit in flavor. One sort of says that, well, can we have a self-managed super fund? Can we use the concept called installment warrant? And under the installment warrant, can we utilize the super fund to purchase the property? The answer is yes, you can, provided that you've taken the right advice from the financial planner, provided that it is right in your circumstances, provided that it is on the basis of your investment strategies. The answer is yes. So my understanding is that the bank sort of allows you to lend or to borrow up to 80% maximum, yeah? And many of the banks are 20%. So I look back into someone said Liberty as an example, second tier, up to 80%. My understanding is that Macquarie as an example, and some of those sort of things change over time, right? Macquarie as an example, up to 80% on a P&I, depending on where you buy. If you look through St. George as an example, it only goes to 70%, NAB 70%, and CBA and so forth. So most of the banks between 70 to 80%. So where it becomes attractive to people is that, let's say you've got a 200,000 as in your super fund. I ask the question that, well, how is your super fund performing? And very often I hear the question, well, I don't know. I was like, okay, what's your balance on the super fund? We'll go back more basic. Oh, I don't know. Well, have you seen your last annual statements? No. Do you know where it is being invested? No. And you know what? This is very common. And to be fair, this is where I was a number of years ago. Why? Because I look at myself and I say, oh, good Lord, 65 years is the retirement. And who knows what will happen at the age of 65? That's too far away for me to think, right? I mean, the government plays with the rule of the super fund all the time. Who knows? Government may just impose some tax or take away. Who knows? So it is lost in our mind. And very often, while it is lost in our mind, unfortunately the performance is not the very best. So this is why the comment sort of comes in, is that at a bare minimum, have an interest. Find out what the super fund is sort of doing. Find out what sort of investment that super fund has. So say 200 odd grand that you have, arguably what that does is that it gives you leverage all the way, arguably, all the way up to 4 times. So you can purchase a property up to maximum, mind you, is about 800 odd thousand on that example, subject to some liquidation rules, subject to some capital minimum requirements from the bank. So there's a whole lot of, I suppose, disclaimer as such, but I'm generalizing. Let's say up to 800,000. Let's even make it 700,000. So your 200,000 is the deposit, 500,000 is the loan, you've got a 700,000. So we speak, Jack, that property sort of whether it doubles every 7 to 10 years. We challenge ourselves and we sort of say, well, if it does double every 7 to 10 years, I can give you lots of statistics where it has, right? But let's say if it doubles every 7 to 10 years, means that what's the level of the return that we're receiving? There is a concept called rule of 72, right? So on the rule of 72 means that if it doubles every 10 years, means that your compounding return is about 7.2%. And if it doubles every, say, 7 years, means your compounding return is about 10%, yeah? So if we say even say 7%, conservative, right? So 200,000 deposit, we're buying a property, say 700,000. At 7% return on that 700,000 is about 49,000. 7 times 700,000 is 49,000. I compared that 49,000 with my initial cash of 200,000, and I say, you know what? That's a pretty good return. That's about 1/4. That's about 25% return. Now there's no hiding. There's no hiding that you use the leverage. So what that means is that if we have a negative 7%, we are in trouble, right? So you still need to buy the right property. Absolutely, 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 you need to buy the right property. But super fund, if it's being utilized in the right way, it gives you the leverage. And super fund is probably as asset protected as it gets. It gives you the control. It gives you the control in the sense that it gives you the asset class where you do know where your investment is. The ATO attention, and again we can spend quite a bit of time. Now the things which I see quite a bit of pitfall, and I'm a little bit mindful of the time now, the way we see quite a bit of pitfall is the initial expense. ATO becomes quite wary of all the initial expenses that you incur in terms of purchasing that property. Is it capital? Is it revenue? Is it deductible? Run that through with your accountant. ATO asks the question quite a bit, was the property available for rent? So you bought a land, right? And my client's case as an example, the inheritance land, it's been around for the last about 10, 15 years. Was it really available for rent? Well, we sort of can't claim it, right? Let's say another example, someone bought a land with a very clear incentive that yes, we're going to construct something in there. Then while the land is there, while you're going through the construction process, the interest can be deductible, even if the fact that you do not have the rent at that stage. You need to ask the question, a particular expense that you incur, is it capital, is it revenue? So the depreciation that we ask, so we put a hot water system, we put a AC electronic system, that whether it's deductible, whether we claim it over a period of time. An area that ATO gets a little bit irritated is one of the line item in your return called sundry expense. So ATO has got a whole bunch of expense, yeah? Anything which sort of doesn't fall in within that expense, we put it quite a bit on the sundry. And ATO sort of says that anything which is unusual, we will utilize our benchmarking and we may ask you the question. So we as investor, our objective would be is to say that, well, every single return is being prepared with our accountant, where if there is any level of query from ATO, that we've got every single line item as substantiation. And you're supposed to keep it for over 5 years, right? At the bare minimum, and ideally probably 7 years. Benchmarking is where ATO gets quite iffy. So one example, as an example, so we go back to our first example. So we've got a principal place of residence, we use that as a deposit to buy our first property. Then that first investment property increased quite a bit in value, and you know, 500,000 has become 800,000. And what we did, that extra 300,000 that it grew, we just taken away another 100,000 out of it as an equity, as a deposit to buy our second investment property. The reason I was sort of raising right at the beginning that be careful where you claim that interest. Your interest is deductible, no question, right? Because you use that extra 100,000 to buy your second investment property. But the question comes in is that, where is that interest claimable? Yeah. So because in the first year, let's say in the last year, you only claim $400,000 as a deduction, so you've got a certain amount of interest. Next year, all of a sudden, if you claim 500,000, let's say, because your loan has increased, then in the ATO system, it creates a bit of an anomaly. ATO sort of says, hang on guys, you had about 20 odd grand interest, which was, let's say, 5% of that 400,000. All of a sudden, you're claiming 25%. Why has the interest rate increased? ATO will ask that question. ATO doesn't, the system does, right? System is very sophisticated. System asks the question, well, it's a brand new property. You really haven't done any level of repairs or maintenance or any level of capital work. Your rent hasn't really increased. So why has your loan increased? What was the purpose of the loan, right? So you got to ask this question. You got to go the science behind it in terms of the deductibility. So it's not so much the form, it's more in terms of the underlying nature as such, yeah? So case studies, well, there's so many examples that one goes through. So deductions with new house and land. Now I can give you an example of a gentleman. I still remember the gentleman that I sort of caught up with him quite a while ago. He's a very high professional businessman, entrepreneur, brilliant. He created a chain of business that he sort of built it, and he sort of sold it over a period of time where he sort of had $1 million plus income literally last 5-6 years or so. So the gentleman came in, and gentleman said, the first thing he said, Munzurul, I'm very good at making money. I was like, well, that's good. That's good. That's a good start. And he said, I'm better at spending it. I was like, well, that really doesn't help. And he said, well, you know what? That's why I am with you. I said, okay, interesting. All right, that's fine. Let's go through. What's your assets? What's your liabilities? And what's your income and expense? And it's over $1 million sort of an income. And I said, well, what's in the cash at bank? He was like, nothing. I was like, mate, you had a lot of income. I was like, yes. I was like, you're single? He was like, yes. I was like, okay. So what did you do? I was like, I had good time. I was like, you had lots of good time. He was like, I had lots of good time. Of course I had lots of good time. Right? That's why I'm with you. So I suppose that rationale behind it is that it's not necessarily the person who sort of has the higher level of income are the wealthy. I can give you another example. I've got this gentleman, I call him the Aussie battler, and I've got a number of the Aussie battlers, right? So this is a gentleman who has never earned more than 55,000 as a salary income in his life. And his income now is about 55, and the gentleman is about 55, 57 years old or so, right? He's got an asset base at the moment, based on what the valuation is easily about $11 to $12 million plus, and his leverage is hardly about 2 million. Hardly about 2 million. So I look back to him and I say that, you know, this gentleman has built about 10 million or so as a net asset on that sort of very subtle income. There were no inheritance, there were no gift, there was nothing. Yes, he has done it over 30 years. That's what he has done it. Yes, when he bought the properties, they were not $1 million property, they were some crazy, say, 100,000 or even lower the price. But he built it. So your wealth, where your income is important, is not necessarily the income is the sole objective as such, right? Asset protection strategies, we discussed that there are lots of strategies. People sort of purchase properties on trust to provide you the asset protection as such. Tax tax planning strategies, I suppose, is the deductibility of the tax planning. And I say that tax planning strategies are very often, there are two types. You've got your micro level and you've got your macro level. So your micro level of tax planning is more in terms of what you can claim. All those deductions which we went through, can you claim them? Your macro level of tax planning is that you structure yourself in a way where you get the best possible deduction as such. Run that through with your accountant. And retirement strategy, this is where we really sit down and we say, why are we doing all of this investment? What's our longer term goal? What are the SMART goals? What's the level of the income that I need in terms of my retirement side of it? So, argument's sake, let's just say that I say, you know what, I can retire on $100,000 a passive income. What does that mean, that $100,000 passive income? In my view, I do a very simple maths, and I say, well, if I need $100,000 passive income, I'll use a 5% as a return, as a gross up. So I'll divide that 100,000 with 0.05, which is 5% return, gives me about $2 million asset base. So if I had a $2 million, arguably providing a 5% return, I get about 100,000. Right, then I say, well, you know what, I need a house to live. And in Sydney, nowadays, everything is $1 million plus, right? So on that example, my retirement strategy becomes a $3 million net asset that I'm targeting. 2 million gives me that 100,000 and the retirement. So we work it through to see how do we get. Succession planning, that we work through quite a bit as well. This is where with the right accountant we discuss that what are the estate planning. What do I do? How do I pass it to the next generation in the most asset protected manner and in more transparent manner, more tax effective manner? What does the testamentary trust means? Do I need a testamentary trust? What do I need? I mean, people sit down and I'll say that, well, what sort of will do we have? I can guarantee you, you can download a will from the internet, one page, free. I can also guarantee you with a certain level of solicitors, it would cost you about 10 grand. And I think both is rather extreme. You need to understand what you need, what your circumstances, you prepare the will, you prepare the estate planning on the basis of this. If there's one question, ask to your accountant, do I need a testamentary trust? What does that mean? So the wealth creation strategies, and this is where I suppose the groups that have come in, the GR Prosperity Group, I suppose the comment that I say, my only comment with the wealth creation, and I was reading through some of those quotation again, and one thing which comes into my mind over and over and over and over and over and over is the action. One probably argues that any action arguably is better than no action. Right. So one last example I might provide is that a good friend of mine, many years ago, that when I purchased my very first property back in 1999, I bought it for about 120 grand, very simple, a 3-bedroom, 350 square meter or so. Now this friend, he was so attention to detail, your good friend, mind you, so I would not give away the name. So this friend, so attention to detail, right? He was your classic example of analysis paralysis, right? He would, everything which I would find that there would be some issue. You know, that old saying, Albert Einstein, is that with the right person, is that every problem has a solution, and he would always come up with a reason why he would not buy it. Just one example is that when I bought a property in Brisbane, I remember the gentleman and I went to Brisbane and we did a research for about a week or so, right? And I bought a property at that stage for about 115 grand. And the gentleman came in and we did a research for about 1 week, and being in the ground in Brisbane, and his answer was after 1 week, nah, I'm unsure, I've looked into a couple, I'm not going to buy it. And I was like, what do you mean? And he was like, well, the prices are a little bit overpriced. I was like, well, give me an example of a property you're looking at. It's like, well, I'm looking at this brand new property in Marsden. And this is back in 2000, right? It's a brand new 4-bedroom, double lock-up garage, about 650 square meter or so in Marsden. And the gentleman wants about, in his case, I think from memory, was 116 grand that he wanted. And I was like, okay. And he was like, well, I think the value is 115. And I was like, mate, how do you know even the value is 115 or 116? What is the definition of the value? And who worries about that $1,000? Pay the $1,000. I was like, no. As part of the ethics and principle, I'm going to pay 115 and not 116. So he didn't buy it. Mind you, that property sort of increased and increased over time. So that's the example of that gentleman. So what he ended up buying, and this is the poetism of it, is that after all the research and everything else, is that I bought that the Ingleburn property, and after 6 months or so, he bought a 3-bedroom townhouse at that stage for about 179, which was a newish property, and just as a perspective, the real market value of this probably was hardly about 110, 115 or so. He ended up paying quite a bit extra. Somehow it's sort of, whether he was analysis paralysis, where he was like, you know what, I need to make some decision, whether he got into something or something and something, right? So it hit him quite a bit, and he looked back and he sort of says that, well, that didn't really work out well. But the beauty of that is, the story is that even though, in my opinion, that he actually paid literally probably about 1/3 of the extra price, I look back into that property after about 18 years and I sort of say, you know what, the valuation of that property probably about 650 odd grand. So even on a bad example of a property where he started pretty bad as a sort of a negative equity, given the time, it has still solved the matter. So any action, yes, not negligent action, but any action ideally is better than no action.
Thank you, Munzurul. It reminds me going to one of the seminar, it's a Tony Robbins seminar, and he started showing knowledge is power. Raise your hand if you agree knowledge is power, knowledge is power. And everyone is saying, yes, yeah, we have knowledge is power. And he came up with saying knowledge is not power. He's saying execution is. Because looking at today, we all are so knowledgeable that we have everything on our fingertips. Pull out your phone, ask any question to the Google God, and you won't get one answer, you'll get 10 answers. And still, having the information on fingertips, still we are, like, you know, according to ABS, the only less than 5% of Australians retire financially free. Even though property is such a lucrative asset, as Munzurul was saying, people go for short term. They want to get rich quick today. You know, when Bitcoin last year, Bitcoin was a big case, and everyone was flooding towards Bitcoin because it was a overnight get rich quick story, and everyone wants that. But in property, because people don't see it as a long term, they want to make money overnight, and property doesn't make money. That's why they avoid it. So, Munzurul, if you may allow us to ask few questions.
Sure.
And I may start with the first questions, yes, and then we'll continue from you. Munzurul, you already touched about land tax.
Yeah.
And you know, as the portfolio is growing, I want to avoid land tax.
Yeah.
What is the way how we can save land tax?
Land tax is one of those dreaded tax that you can sort of minimize it. I suppose you can sort of almost eliminate that for a period of time, but it's one of those dreaded tax which you sort of end up paying it, yeah? How do you minimize it? Is that if you buy in the right structure, if you buy into the right estate, if you do your concept called diversification, so if you buy it in different estates, then what you receive is that you receive multiple level of threshold. So land tax has threshold, right? New South Wales has one threshold, Queensland has one threshold, and Victoria has got one threshold. So in an ideal world, if you do it on sort of a diversification, few in New South Wales, few in Queensland, few in Melbourne, then you get different level of thresholds. Yep, that's one. The second is that if you buy it in different structures, so in trust as an example, that each trust has got about 350 odd grand. So sometimes people buy a couple of properties into one trust, and then a couple of properties into trust 2, and a couple of properties into trust 3. So you minimize this way, yep. One tip with the land tax, if I may, is that arguably never purchase it on a joint name as being husband and wife, yeah? Buy it on individual name, buy it on his name, buy it on her name, buy it on one on his name and one on her name, right? But don't buy it on a joint name. And the reason I say that is that the land tax, while it has got that 630 odd grand threshold, is that that's for each individual. But as soon as you buy it on a joint name, rather than becoming a threshold for him and a threshold for her, you get only one threshold as a partnership. So you actually pay land tax a lot quicker. So there's a few tips. There's a few tips along the way. But at the same time, you know what? I take a step back and I say it's very, very important to look into the bigger perspective. There are some costs along the way, and we don't like to pay those costs. We minimize them as much as we can, but we take some of those costs as part of the cost of doing the business.
Let everyone else.
Sure.
Just a question about the family trust. Can you put your house that you're living now in a family trust, and then use the equity of that to buy a property on a single person as an individual?
Yeah, the answer is anything is possible. The question is that whether it's practical. And where it comes in is that whether you can buy it on a family trust, the answer is yes. Yeah? As long as we do it because of a commercial reason and not so much for a tax minimization. Because when we do purely for a tax minimization without any commercial reason, then it becomes a tax avoidance. Yeah. So you can. And in the family trust, what's the benefit? I suppose having a principal place of residence, because you are living in there on your own name, the principal place of residence, means the interest is non-deductible. Yeah? But if it's on a family trust, the family trust owns it, and you are the one who's the tenant living into your own home. It's even better. It's a furnished house. So that means all the furnitures are also deductible as well. So you can claim the interest, you can claim all the furnitures, and so forth. So that gives you quite a bit of benefit. Yeah. Where you got to be careful is that it takes away certain benefits. Number one is that in the family trust in South Wales, no land tax threshold as we spoke, right? So if you were to own it on your own name, that's an exempt from a land tax point of view. Principal place of residence, there's no land tax. If it's below a certain value, below a certain land size, there's no land tax. Whereas in family trust, you pay the land tax. Number two, principal place of residence are exempt from a CGT point of view when you sell it, irrespective of when you sell it, how you sell it. On a family trust, it's not your principal place of residence. You are a tenant to your landlord, which is your trust. So that means if you do sell it over a period of time, you've got to pay the capital gain tax. So I suppose the answer is that can you do it? The answer is yes, you can do it, but it comes in with some significant negative that you must sit down and do the calculation in great detail and make a conscious decision. And most importantly is that if you do it purely for tax side of it, ATO may just absolutely disallow. And can you, sorry, my apology, the second part of the question is that can you use that equity to buy property on individual land? That bit is absolutely, the answer is yes, you can. Can you claim that as a deduction, that bit of the equity or the funding that you use? The answer is yes. On whose name would that be claimable? Would be on the individual's name. Because what the family trust did is to extract a bit more equity, hand it over to Mr. X. Mr. X used that as a deposit to purchase the property. So family trust paid the interest because they borrowed from the bank, and the chain of the transaction is that Mr. X pays off that to the family trust. So it's a nil result on the family trust point of view, and the deduction is on the Mr. X. So the answer is yes, it can be done, to your second part of the question.